looking back, like it's pretty cool to see the types of people I was exposed to both through our neighborhood, but through church that just existed. And if I'd had a little bit nudge towards one or the other, I could have taken advantage of those opportunities. And then like in the world I play in now, like in the investing space, I kind of dabbled and fell into it. So I didn't really have any mentors when I first got started on the investing side. But I quickly learned after my first investment failed what made companies work and not work. And so I dove into various sources that are out there that talk about early stage investing. And, you know, what I found is there's actually a lack of investing education even out there in the traditional investing ecosystem, I'll call it. Because there's so many different types of companies and so much it's just focused on like the future, like $1 billion unicorns of the world. But who teaches about the diversity across like somebody who likes to invest across real estate, something that's also cash flowing on maybe like a revenue share basis, and then reinvesting that back into high growth startups where $1,000 check could potentially become worth, you know, 300, 400,000. I haven't found anybody that's talking about that sphere of all three of those and one that's normally delineated to just real estate or just cash flowing boring businesses or just high tech growth startups. And I think there's a cool intersection between the middle.
Yeah, I think that's a great point. And, you know, coming from someone who only got into investing like a few years ago, I really haven't come across anything like that. Even just like venture capital and more private investing, things like those, there's way fewer resources out there. And maybe that's because it's more, I guess, enclosed, at least for now. And that's sort of kind of what crowdfunding is doing, is allowing more people to get into private investing, I think. And we'll kind of dive into that. But I was curious, you kind of mentioned how you learn from these sources, you know, what to look for and what not to look for after your first investment didn't work out. Maybe what are some lessons that you kind of have learned so far of that really have helped you like identify what kind of business or company you want to look for and not look for?
Could you also describe your first investment?
Yeah. So the first investment was in a traveling veterinary company, basically. And, you know, the team just wasn't focused on pivoting as quickly as they should have. That was it. They saw market demand. They didn't pivot. They wrote about it. And so to answer your question, I came up with my own thesis for investing, which so far I haven't had too many other failures, but you expect to have a high, you know, it's investing. It's super risky. Like 9 out of 10 businesses you expect to fail, if not more. Of course, it varies by business type, but like what I learned that works for me, like when my wife and I were looking at something, first and foremost, what type of impact does the business have? Because if we're just investing in something for money, that's cool. You can probably make some money. You might lose it all, but it's just, I don't know, it's not meaningful for us. But from a financial lens, from a sustainability lens, we look at, is the team actually committed? Like what else are they working on? Is what else they're working on, is it also additive to the startup? Second question I asked for, since we have platforms, you know, where you can go on and literally put in whatever money you want to, I normally ask the teams, what do you need besides capital? If they can't answer what they need besides capital, they probably shouldn't be raising around, private or public. I don't care whether you're taking $1 million check or $100 check. If you can't answer that question, you haven't really thought about how you're going to use investors to grow your business, which is a fatal flaw. Normally after they pass that one, it's like, you know, various things like, does what they're allocating capital to make sense? Big one that we ask is there somebody in my network that can help that company grow? If there is, like, I could either throw money into Apple or Google or something on the stock market, which, you know, I'm trading dollars with other people potentially. You know, there's no way I can drive Apple or Google's gain. Or I can go drop $1,000 into like a local mom and pop shop or a growing franchise or something in our backyard and actually help the company grow, which has meaningful upside for the company. So I'd rather place my dollars in stuff that I can actually control. Because I've seen this world long enough to see even like $1,000 check writer in a company. My son, who was 9 at the time, said, "Hey, Dad, we should invest in that." There's a $1,000 check writer in that company that landed him a $1.9 million order to Sam's Club. Just the investor invested because they thought the company is cool. And then the founders asked, "Hey, can anybody help us break into big box retail?" And the person's like, "I know the distributor." So you got somebody who's not a wealthy individual who thought a company was cool because they could relate to the industry because they're kind of into it. And then the founders met and asked, hey, can you help us grow? And they're like, sure, let me tap my network. I mean, that had a super meaningful impact on a company that had only done 1.4 million in revenue. So they did 1.4 million revenue, then they get an order that's 1.9 million from one investor. That's like the cool intersectional wave that my wife and I enjoy riding, is that we can help the companies grow, but also like build ones we want to have in our backyard.
That's awesome.
And then our kids get to learn from it along the way. And ultimately the end game for me is like, I want to know where my two daughters are like interested, so I can guide them up in the world and connect them with other founders. I'm basically like building a mentor network for my kids.
I guess that's what you're supposed to do, right? As a father and a mother.
I appreciate it more now that I'm a parent. But
yeah, that's pretty awesome. So I'm curious because I know like this idea of investor, and I think a lot of people they think of investing and they're like, okay, let me throw my money in a company that I think is gonna like do good, and then I'm gonna let it sit there and not really and be more passive.
Yeah.
But I think the route that you're taking is more like, okay, you can actually add value more than just money, and that's kind of what helps a company grow. So have you tried like taking that more passive route? And obviously you kind of invested and kind of helped the company grow. Like what is like the two differences between that for someone that like might want to get into this venture capitalism? What is the difference between those two paths?
Yeah, that's a great question. I mean, I played passive in some investments too, mainly because a founder made an ask initially. We answered the ask, and then when they make future asks, it's not something we can necessarily help with. So we're kind of playing a passive role at that time. But I mean, often you'll hear people will put money into passive stuff like commercial real estate. So what's that mean? Well, it's a building like this, or another like a entrepreneur that runs a food business, where you eat, or a coffee shop, or an industrial park where there's a manufacturing plant. Every single one of those buildings has basically what's called a sponsored group that's asking investors for money and saying, hey, look, if you put your money in this, we'll passively pay you, 12% to 30% per year, effectively, if we sell this successfully in 5 years. That's effectively the model. It ranges on time. The rate of return per year, varies, but basically they're just asking people to put money into it. And so investors there are just putting money and basically saying it's backed by the lease of whomever is leasing that space, and that's what's paying our return. Sometimes you'll see passive investment within the venture world. I don't see it as common, but you'll see a high growth tech company that everybody's excited about, and you'll have these people that organize what's called a syndicate, which is just let's all pull our money together. Basically, we need to raise $500,000 or $1 million. Let's all pour as little as $1,000 check or $5,000 check into that. They need capital to grow, but we've already got the team that's going to help them grow. Occasionally, we may make an ask to help the company grow, and that's kind of more of a passive investment too. Generally, I've found unless it's real estate, most of the time an investment has the opportunity to be active, meaning that if you're investing in a commercial real estate offering here and they're already going to be fully booked, like what else can you do to really help the property grow? There's not much. The sponsor could probably leverage you or mobilize you as an investor to help fund their next round. But for that particular, property, unless they have a need for a tenant, like what else can you really do except build like maybe brand awareness? Whereas for like an early stage company or a restaurant or manufacturer or you name it, there's probably a connection within an investor's network that could be mobilized to help that company grow if the right ask is made of the investor. And I found that ask is sometimes the people that invest smaller dollars are sometimes even more active than the people that invest bigger dollars, because sometimes it means more to them. But I don't know. That's kind of the divide in the world I've seen now across 90 different investments and various groups I've been interacted with.
Yeah, that's a great breakdown. Thank you for that.
You're welcome.
So when if I'm someone that wants to get into like this active investing, and maybe you could tell your story on how you first got into it. Maybe you started with the veterinarian story that you said.
Yeah.
But like if for example, I have like very minimal like business experience and I'm wanting to go to a company right now and I'm like, hey, I have $5,000. I want to invest. I believe in your impact and I want to help you grow. But I don't have that impact. I don't have that track record of helping businesses grow. So what is like the sales pitch, or what is like the the motivational factor for that company to like take you in and kind of trust you to build up the company with them?
I find most of the time companies will mostly take capital if it comes their way. There's very few occasions where I think they'll reject capital. And it's only if there's somebody that's being predatory with it. Normally on the flip side, though, I guess we should probably add disclaimers that investing is highly risky. Obviously, nobody should get in this world.
None of this is financial advice.
Yeah, exactly. I mean, I think everybody listening to this podcast knows that. But seriously, like if people have money, they're not going to miss if it all goes to zero. What my wife and I did was, from the investor lens, is we just said, hey, if we had $5,000 of capital, to use your example, we're probably not going to put it all in one company. Probably going to diversify it across, a couple of companies at least, because we're looking to build a portfolio of up to like 50 high-tech growth startups. I call it our little mini VC portfolio. Or we're trying to help along a lot of Main Street businesses that are in the area that like we can go eat and drink there and invite friends there because we already like the food or we like the drink. Or it could be like a manufacturing company that's got something super innovative. We're aerospace guys. So like any company that's doing anything in the space industry, like my kid loves space. So yeah, I'm going to probably put some dollars in there to help advance space and my kid can learn from you. But I'm looking at, is that company one that's got like a potential to actually drive innovation and change there. So there's like a future mentor for my kid while there's also potentially an investment return. So I'm not sure if that directly answered your question, but looking at it from an investor lens, I look at it that way. If I'm looking at it from a founder lens and trying to decide whether or not I'm going to take the capital, I'm looking at that person, one, if there's somebody I know, like, hey, we're building a company. This thing could go to zero tomorrow, get hit by a bus or whatever it may be, literally. Like, is our friendship going to be ruined if I take your capital? Or as a fellow community member, maybe we're not like friends, but a colleague told you about us and you're debating about investing in us. Like, is this going to ruin our relationship? So there's normally some hard questions asked that way. And if it's not, then the question just becomes, great, here's our round, here's where you can put the money in. What can you do to help grow the company? Here's the 3 things we're looking for right now. Can you do one of those things like tomorrow? And if they're like, yeah, great. Do you have a network that can also do that? Oh, yeah, I got some couple buddies. Great. Whether or not they want to invest, can we all have a conversation? Because now we've just taken $5,000 of capital from somebody who wanted to invest. They're highly motivated to invest because they like what we're building. They like the team. Their buddies told them about it. And they've got a network of people that might not only be able to put in capital regardless of size. It might be a $100 check, but they've got a huge network that can help the company grow. That's how companies are built. It was only that we weren't able to do that on smaller dollars until recently back in 2016 when all the regulations changed.